Gordon, you've been a China sort of doomsayer for a long time. Is what we're seeing now the hard landing that you've called in the past? Is this it?
Yeah, well, this is certainly a hard landing because China's not growing at the 7.0% that Beijing claims. It's not even growing at the 2.2% that they're privately talking about in China. It could very well be even lower than that. But if I'm wrong, and I could be because no one really knows where China is, it'll be there in a couple months because what we're seeing is a severe deterioration in the economy. You know, there's the devaluation, there is the plunge in the stock market, but most important, there's the money coming out of China. You know, there are various estimates, somewhere between $520 to $800 billion in the last 5 quarters. That's a lot of money. That's the Chinese people voting with their feet. That's what basically they're saying is this economy doesn't have a future.
Well, we spoke to David Wu, head of global rates and currency research at Bank of America Merrill Lynch yesterday, talking about China's stock market and what's going to keep it rising in the near term, though. Take a listen.
People now realizing we're now basically 4 or 5 days away from the parade in Beijing to celebrate the end of the Second World War. Presumably, the reason why the Chinese started to intervene in the stock market directly is because they don't want the president to look bad when the foreign dignitaries start to show up in Beijing.
What do you think about that?
Absolutely. I mean, because, you know, they did not intervene on Monday, Tuesday, Wednesday, and we saw the stock market fall. But lo and behold, in the last hour on Thursday, it went up 5.3%. Yesterday, 4.8%. That's completely inexplicable. This is government buying in the last hour of the afternoon session.
One of the things that Wu said in the interview is that we could see a return to further UN weakness after the parade, and that maybe the devaluation we saw was just the beginning. He was even talking about the government letting the currency go completely. What's your take on the government's currency policy at this moment?
Well, eventually they're going to have to do that because that's the way the economy is going and the currency is at an unsupportable level. You know, they're spending, the FT says, about $10 billion a day to support the value of the currency. And that means in 21 weeks, you go through $1 trillion of reserves, and that number could actually increase because as people start to realize how bad things are in China, you can see the pessimism build both inside and outside China. Therefore, you could see even more money coming out of the country.
We did see, if you take a look at their FX reserves, SocGen had a note out this week talking about the extra firepower that China has that they don't actually need to support their currency. Well, that's not quite it, but yeah, there you go. And basically, they're saying that they have about $900 billion that they can play with to support their currency and help with capital outflows. Do you agree with that?
You know, who knows what they have because you can't really trust what they say about their foreign exchange reserves. But obviously, look, they say they've got $3.65 billion, at least through the end of last quarter. They probably have a lot less now with their burn rate. And that burn rate, as I said, will probably increase. So, you know, this country, which looks invulnerable now, could very well end up being the real basket case of next year, or maybe even the end of this year with the way things are going, because the economy doesn't have any support there.
Deutsche Bank was out with a note this week in which they used the term quantitative tightening, and they basically made the argument that China's reserves have grown roughly at the same pace as the Federal Reserve's assets during quantitative easing, but now they're coming down. As you can see on the chart, it's the purple line has started to decline. And so Deutsche Bank is saying that this is an issue for the entire world, China's reserves starting to head down. Do you see global ramifications from this?
Only because of the panic, but I actually think China is less important to the global economy than most people think. Because, you know, everyone says it's an engine of global growth. Well, to be an engine, you've got to buy the goods and services of other countries to create growth elsewhere. But China, through mercantilist policies, has actually been taking growth from other places. And, you know, the manufacturing that is done in China, well, that'll be done in Vietnam and India and elsewhere. So the global economy will adjust. But people will panic because there is this perception that China is critical to everything. And I think that that's wrong. But that's the way the world works these days. So therefore, there will be problems when China has even more difficulties that are more evident.
But in terms of the actual stock market, do you think that that actually has an effect on Chinese consumption? I mean, they can still grow that. They're really invested more in real estate than they are with their assets, which under 10%, according to some analysts.
Yeah, well, it has a marginal effect on consumption. You know, we've seen the reporting about people not buying luxury cars and even not buying mid-sized cars because of the falls in the stock market. People had put their money in there. They had hoped it would ride. They'd take it out when they get something that they want to buy. That's not happening right now. But also, you know, consumption really hasn't been as vibrant as the retail numbers suggest. I think that it's been growing, but it's not been growing at the rate that everybody thinks. So it hasn't really been the pull for the rest of the world. We see that in the really bad import numbers, for instance.
All right, so you already have a very gloomy assessment of China.
A realistic assessment of China.
Fair enough. But what's your nightmare scenario for China that keeps you up at night?
Well, basically that they have a 1930s-style crash. See, leaders there cannot affect the downward trend in the economy. They can slow it, and they have been slowing it for a number of years, but nothing's working. Monetary stimulus is not working. Fiscal stimulus would be dangerous because it creates debt. They can't reform because of problems in the political system. The stock market boom was a bust, and now they're devaluing their currency. This is a country where the leaders really cannot affect the economy for the better.